Welcome to Channel's Business Global with me, Juliana Olayinka, from our studios here in London. Over the next half an hour, we'll be looking beyond the business headlines by giving you in-depth perspective on the stories that are affecting all of us. Coming up on today's show, I'll be speaking exclusively with Natalie Colby, a private equity partner at Actis, for some insight on the group's private equity portfolio. Actis is a leading investor in growth markets across Africa, Asia and Latin America, raising $19 billion since inception. She'll be joining us from Johannesburg. Then later, Greg Swenson, partner at investment banking firm Brigg McAdam, joins me to discuss Africa's growing debt crisis. But now over to our first topic, Brexit. With less than 30 days to go until the end of the transition period, a group of cross-party British MPs have warned the government that channel crossings are at risk of serious disruption and delay. In a scathing assessment of the way ministers have planned for leaving the customs union, the Commons Public Accounts Committee questioned the UK's level of preparedness, adding that they did not believe the necessary systems are in place whether or not a deal is reached with Brussels. Rod Mackenzie of the Road Haulage Association said the best case scenario is that it will be shambolic, the worst case scenario is that it will be catastrophic. Here are some other Brexit flashpoints of the week. The EU's chief negotiator, Michel Barnier, has warned European capitals that post-Brexit trade talks can still end in failure. The three main sticking points, fishing rights, common standards, including state aid and governance, are still blocking progress. French President Emmanuel Macron has reportedly threatened to sink a UK-EU trade deal as tensions over fishing rights intensified. He warned Brussels negotiators that his government could veto any agreement that doesn't guarantee French fishermen access to Britain's coastal waters. Well, for more on this, I'm now being joined by our business correspondent, Simon Pusey. Simon, the last time we spoke, Michel Barnier had just come out of mandatory isolation, was on his way to London. Are there any updates on the negotiations?
Yes, there are. There are no substantive ones, but and there's a lot of rumour going around about what could be happening behind the scenes. First thing to say, I guess, is that earlier in the week, Sterling leapt at the rumour mill in various papers and on various radio stations that we were in the tunnel stage. The so-called tunnel stage means the sort of final phase of negotiations before there is announced that there's a big deal. Unfortunately, that has not sort of materialised in the last few days, and it doesn't look likely that it's going to. Everyone is still positive in terms of the rhetoric around what's going on. The EU side, senior Irish negotiator Simon Coveney says both sides must avoid engaging in a blame game and he wants a deal. Germany's Angela Merkel has insisted a deal is in everyone's interests. Likewise, the UK say they remain committed to reaching a trade deal. That's according to Number 10. Michael Gove saying that he thinks there's a 66% chance that a deal is going to happen. Where he's plucked that out of, I've no idea. And the Foreign Secretary Dominic Raab saying that this is the last week really of substantive talks. So everyone's sort of pushing, rhetorically anyway, using words that are trying to be positive to get a deal over the line. But there are still these two big blockages, and that is fishing rights and also competitiveness within the UK. And I'd say that there's also quite a lot of rumour about France and a couple of other hardline EU countries that are just seem like they've had enough now. They want to walk away with no deal, and they sort of seem to hope that the UK will come back in a couple of months, sort of cap in hand, saying, OK, can we try again, try and do something. Another thing to say is that the news that we've had this week that Pfizer is being rolled out across the UK. Some pro-Brexiteers have been saying, well, this is only possible because we have left the EU and all the restrictions that come with it. That isn't true. We are still bound by the EU in terms of those restrictions up until the end of December. So just to clear that up. So we don't have anything really too far to go on in terms of how Brexit's going at the moment, but negotiations are still ongoing. Michel Barnier is still here and they are still trying to hammer out a deal.
Actis is a leading investor in growth markets across Africa, Asia and Latin America. Over the past 16 years, the firm has raised $19 billion for a private equity portfolio that focuses on consumer, financial services and healthcare businesses. Natalie Colby, an Actis private equity partner, joins me now from Johannesburg for more. Natalie Colby, thank you so much for joining me on Channel's Business Global. No surprises, Actis have had a pretty successful year. In fact, you've been commended throughout the year with a couple of awards and recommendations for your commitment to sustainable and responsible investment. How significant is the climate emergency to your investors?
Yeah, Juliana, look, this is probably becoming one of the most important topics of conversation with our investors. And many of them are asking us questions as fund managers as to how we are helping our portfolios decarbonize, and also what our investment strategy is in the whole energy transition. And we've actually seen some investors take this one step further, where they're looking to divest from fossil fuels, and where they're being deliberate about not investing in private equity firms that are still investing in coal-fired power stations. And we should really expect this momentum to continue. I mean, I think if we look back, at where the tobacco industry and the alcohol industry ended up on kind of banned lists for pension funds to invest in, I don't think it's hard to imagine a future where fossil fuels will find their way onto that banned list as well. But look, this is good news, right? I mean, this is all going to be very helpful in the shift to a more cleaner future. And as actors, we've been investing very actively in the renewable sector, in the emerging markets specifically, investing in solar and wind farms across Africa, Asia, and Latin America. And I think the exciting part about this is that we think that emerging markets will quite possibly leapfrog the developed world. Emerging markets don't have established, or often, very little coal-fired power stations in the markets, particularly the poorer countries. And we also don't very often have a working national grid. So I think we'll see a trend towards a more decentralized and localized energy solutions. If we think about rooftop solar home systems and mini grids that will support local communities or industrial parks. And I think that this will completely leapfrog the need for expensive national infrastructure, and really make a very compelling investment opportunity for investors in the space.
Thanks, Natalie. What are some of the challenges? Because we do know, especially in a country like Nigeria, where the majority of our viewers will be watching this from, they obviously rely heavily on oil. Bernard Looney, the chief exec at BP, has said, oil is now a dirty business, that they're really trying to come away and become a much greener, leaner society. But this isn't, of course, that easy in places like Africa. And in fact, some are saying some of the regulations that have been put in place are really unfair. Can you see that there are challenges in trying to be sustainable?
Yes, absolutely. I mean, look, it's never an easy road. Look, I think the biggest challenge that we find from a sustainability perspective in our markets is really that we're often not playing on a level playing field, particularly when it comes to kind of corruption and business integrity issues. And this is a perennial problem across all of the markets that we're investing in. And I think the single biggest enabling factor that governments can fix to attract foreign direct investment into our markets is to really institute a level playing field through the rule of law, and ensure that there are investor-friendly policies. I mean, I think the other important part around sustainability, which is often kind of forgotten about, is the S. If you talk about the kind of old ESG, or the environmental, social, and governance, that S part, the social part, and really looking at how we work with the communities where we're operating. Often we're building these wind and solar farms on land that's owned by communities. We're building residential or retail parks in communities, and investing in factories there. And really, although at the outset this may look like a challenge, we actually see this as a very big opportunity to establish a symbiotic working relationship with these communities. And I'll use an example of a wind farm that we built in Kenya called Kapeto, where we built this on communal land owned by the local communities. And the benefit to the local communities is that they will earn a percentage of the revenue generated from that wind farm. We've also built sustainable housing for them. And we also put in a training program that will draw people from the local community and train them in skills that we actually need on the wind farms to be able to draw from those much needed skills that we need, and obviously providing much needed skills for the community. And the alternative to not doing this is a disgruntled community that could end up with blockages and strikes, and actually then completely derail the project. So we're very focused on this part of sustainability, the inclusive side of bringing people along with us, creating a symbiotic relationship with them, and creating sustainability in providing core services and infrastructure needed in our markets.
Absolutely, Natalie. Clearly, the Actis investment is trickling down to those who really need it. Let's move on to data. Data, huge topic of discussion on the continent, not just the fact that it's the most valuable commodity, but data colonialism has also been a topic of huge concern. You established a $250 million Pan-African data centre platform. Part of this was a huge stake in RAC Centre. Can you tell us a little bit more about this? And are you seeing more thirst from your investors about gaining access to African data?
Yeah, Juliana, this is probably one of when talking to anybody on the continent and in other emerging markets, this digital infrastructure sector is one that is gaining a lot of interest from investors. And look, the world has already been on a very steady journey towards digitization and data usage, but COVID has just accelerated that. I mean, many of us are working from home. We're doing interviews like this online. We've got our students that have moved out of the classroom and into an online environment. And all of us therefore need a very fast, efficient, and importantly, reliable data links. And there's a smorgasbord of opportunity to invest there. I mean, first of all, there is the fiber to home opportunity. So we've invested just recently in a business here in South Africa called Octatel, which is one of the leading fiber to home businesses in the Western Cape, to really bring that data and the data links right into your home. And as you mentioned, we last year established a $250 million platform for data centers, and the first investment that we made was in RAC centers in Nigeria. And really the plan there is to double the capacity of RAC centers to ensure that we can keep the data local and in Nigeria.
Natalie, I've got to ask about COVID-19. It wouldn't be an interview in 2020 without talking about coronavirus. We are finally, hopefully, seeing light at the end of the tunnel. But, before it took a grip on the entire world, everybody was talking about seeing piles and piles of bodies in Africa. That never happened. Of course, it did hit, but it didn't hit that hard. But financially and in terms of investment, how has it changed the outlook for Africa? Is there more risk? Are you seeing people, holding back a little bit, just waiting to see how the dust will settle?
Short answer, yes. I mean, certainly at the beginning of the pandemic, we did see people shutting up completely and obviously kind of going a bit more internal and making sure that their own houses were in order and that there was liquidity in the market. But there absolutely, I think there's going to be big opportunity that comes out of this COVID pandemic. And the first one is that there is a big need for infrastructure in our markets. I mean, this is clear. This has always been part of our investment strategy, whether it's in Nigeria, South Africa, Kenya, or other parts of the world. And the need for infrastructure is there: ports, roads, energy infrastructure, like we've spoken about, digital infrastructure, which is going to become a lot more prevalent. And governments have run out of money. I mean, certainly what little money they had has now been completely emptied out with the response to COVID. So there is going to be a need for foreign direct investments and, frankly, even the local pension funds to get involved to be able to support infrastructure on the continent. So I think there is a big opportunity. I think that the second opportunity where I think there's going to be a lot of investments to be made is in this kind of connected world where there's a lot of technological advances. There is certainly an opportunity for people on the continent to be able to bring products and services that our communities so desperately need, but at a price point that they can access. And that is through technology. And I think, again, COVID has accelerated that. So, and again, I think the exciting thing about emerging markets is that we can leapfrog old industries. The old way of doing things that cost a lot of money, we can do it quicker and easier with technology. And let's just think about online education. Potentially gone is the need for big expensive universities when you can get a Harvard professor in your living room. Telemedicine, the long trip to a clinic down the road, people can now access a very good doctor online, for a consultation. And also just making markets accessible through online portals, fintech, payment gateways, etc. I think there's just a big opportunity there where technology will be able to accelerate a great investment opportunity for the continent.
Natalie Colby, partner at Actis. What a thorough breakdown that was. Thank you so much for speaking and joining us on Channels Business Global. Thank you. Coming up on Channels Business Global, I'll be speaking with Greg Swenson, a partner at the emerging markets investment firm Brigg McAdam, about Africa's growing debt crisis. See you after the break. Welcome back to Channels Business Global with me, Juliana Olayinka, from our studios here in London. In a moment, I'll be speaking with Greg Swenson about Africa's growing debt crisis. But before then, here's some company news for you. The British fashion group Arcadia has fallen into administration, leaving 13,000 jobs at risk. Arcadia's market share slumped from around 4.5% in 2015 to just 2.7% in 2020. The group's extensive portfolio of high street stores, which includes British high street staples like Topshop, Dorothy Perkins, Burton and Miss Selfridges, has long felt outdated. The collapse of the Arcadia Group marks the UK's largest corporate casualty of the pandemic so far. And to another retail casualty, Debenhams, Britain's biggest department store chain, is permanently closing its UK operations. The announcement came less than 24 hours after Topshop owner Arcadia filed for bankruptcy protection. Together, the business failures put 25,000 UK jobs at risk. Debenhams, which collapsed into administration in April for the second time in 12 months, said in a statement on Tuesday that it had been unable to find a buyer and will begin to wind down operations. Its 124 UK outlets and online store, employing 12,000 people, will trade to clear stock, after which they will close if no other offers for the business have been received. The future of its 45 franchise stores, which are primarily in the Middle East, Southeast Asia and Eastern Europe, also depends on whether a buyer can be found for the UK business. Holiday firm lastminute.com has agreed to repay more than £7 million owed to customers whose package holidays were cancelled due to the COVID-19 crisis. More than 9,000 customers are waiting for refunds, and the move follows pressure from Britain's Competition and Markets Authority. The watchdog is currently chasing more than 100 package holiday firms to get refund commitments, as the travel sector has been deeply affected by the coronavirus crisis. The firm has agreed to repay at least half of customers by the 16th of December and the rest by no later than the 31st of January 2021. Now over to our next topic. Zambia appears to be the first African state that has defaulted on its international debt payments as a consequence of coronavirus. The Zambian government potentially owns the Chinese government in excess of $23 billion in loans, project money and infrastructure. The default has led to fears that a debt tsunami could engulf the continent's most heavily indebted nations as the financial impact of coronavirus hits. For more on this, I'm now being joined by Greg Swenson, a partner at the emerging markets investment firm Brigg McAdam. Greg Swenson, partner at Brigg McAdam, thank you so much for joining me on Channels Business Global. We're starting to see the beginning of the end of COVID-19, and as the dust begins to settle, a lot of economists and observers are looking at the fallout, particularly in Africa. We had the G20 summit wrapped up last week, and one of the pledges or the commitments was to kind of extend some of the debt relief in Africa. But there are lots of Africans questioning as to if Africa can get itself out of its debt crisis. What are your projections on that?
Well, I think it will take some time, and I think you saw the large multilateral organizations, the large institutions like the IMF and World Bank and African Development Bank, gave some relief last summer, to make sure that there were no urgent debt repayments or interest payments that the countries would have difficulty in handling. But I think from a sovereign perspective, I'm not really sure the capital markets are open. At least for any notable scale or size in terms of debt issuance. That's going to be a challenge. So I think most of the post-pandemic investment and relief should be coming from the private sector and perhaps from the DFIs, but that are investing directly in the private sector and into projects as opposed to just sovereign relief.
Absolutely. Zambia has become the first African country to default on its debt since the pandemic. There are major concerns now that there could be a debt tsunami, particularly in South Africa, also in Ghana nearby. Do you think that is likely to be a consequence of what we've just seen in Zambia?
It could be, and what we hope for is that it's not a tsunami, it's not a domino effect where you start to see, debt service being impossible to meet. So, but I don't think that it's necessarily going to be systemic in Africa. I mean, interestingly enough, the yields in Africa sovereign debt, the dollar bonds, are trading in the mid-single digits in many cases. And so, from that perspective, the capital markets are functioning well. And you see most of the bonds are priced or trading above par. And in fact, Kenya actually is, wrapped around 105. So, these are good signs for the sovereign dollar market. It doesn't mean that the capital markets are open and they could do a $1 billion deal in the new issue market. But it is a good sign that most of the dollar bonds are trading, at or above par, and the yields still remain in the single digits.
Bond issuance in sub-Saharan Africa still does remain relatively low. Of course, everyone can peg that to what's happened in COVID. But is this a trend? Is the risk in Africa, especially debt risk, just not profitable? They just don't see the return on this.
Well, in many ways, I think there are really excellent return opportunities. You still have a premium in Africa above most of the other emerging markets. And, as I said, and a lot of the risk is perceived and isn't actual risk. Now, I mean, I know we've had a default recently in Zambia, but, other than that, other than the particularly distressed countries, I think you can look at the private sector investment as a good leading indicator. This $23 billion project with Total in Mozambique, it's the largest investment ever in Africa. And you've also, it's also one of the largest energy projects in the world right now. That's where the private sector is getting involved with much support from, some of the development financial institutions, of course, and a lot of the Western Exim banks have supported that. But generally, this is a massive investment, and I think you'll see leverage around that, and you'll see success, really driven by the private sector, while the sovereigns, the governments have to, work things out and manage their debt, the debt payment scenario. But I think this is a good sign for the private sector, and there's just a tremendous amount of opportunity in sub-Saharan Africa right now.
God, we've been hearing about opportunity for years. I think Africa wanted opportunity yesterday, not tomorrow, Greg. Got to talk about China. So many headlines. You see China, Africa, debt trap, diplomacy. Can we talk about that a little bit? And how do you think, going forward into 2021, China's relationship with Africa will change as sovereign bonds are becoming more palatable to foreign investors?
Yeah, look, it's a great question, Juliana. And the current debt service in Africa from the sovereigns, 43% of that, or at least the planned debt service in 2021, 43% of that's going to China, about a third to the government, and another 10% to some of the state-owned banks. That's going to change. There's no doubt that the China capital formation gap is real. Not only does China have their own problems to deal with at home, but you also have a pushback against Chinese capital, against Chinese debt, for the reasons that you mentioned, this debt trap that's been created. And I think that the markets have a much better understanding of the risks of taking Chinese capital, and in many ways it's created a great opportunity because you don't have, it's not as crowded. There's limited competition for capital now with China backing away a bit and focusing at home. So look, the last few years were different. You were always competing with really cheap Chinese debt. It made it difficult to get the kind of returns that you'd expect, not just in Africa, but anywhere. And we saw that in Eastern Europe as well. So I think this pushback against the Chinese is creating a lot of opportunities in China for other investors because it's just not as crowded. It's limited competition for capital, which is what investors want. They're not competing with uneconomic debt and equity investments from China.
Lastly, Greg, we're running out of time. Do you think emerging market governments are seeking FDI to bridge fiscal holes, which have obviously been caused because of COVID?
Yes, and I think that's appropriate. And you've seen that support from the financial institutions. At the beginning of the pandemic, it's provided a bit of breathing room and some relief, but also at the same time, you've had massive investment from the West, both in terms of DFIs as well as private equity, to fill those gaps and invest in the private sector, in projects, in critical infrastructure. And as we learn in the West, the best way to allocate capital is through the private sector, not through the public sector. So I think there's some real opportunities for Western capital to come into sub-Saharan Africa.
Absolutely. The scramble for Africa is ongoing. Greg Swenson, partner at Brigg McAdam, thank you so much for joining me on Channel's Business Global.
Yeah,
Sadly, that's all we have time for today, but do get in touch with your comments and suggestions. I'll see you at the same time next week for more in-depth business analysis on Channel's Business Global. Goodbye.